Okay. Now, apart from considering the accounting rules and what and how we feel or how we think that the management could be wrong, we need to consider what is called materiality. Okay, we need to consider materiality of the item. So sometimes it is purposeless. It is useless to argue with management on trivial issues which are clearly trivial, whether individually or in aggregate. So you need to show some professional maturity, okay? Because there's no point in you arguing for things which do not matter. All right. So how do you calculate materiality? There is an acronym RAP, okay, where we are saying you need to determine materiality with regards to revenue. Okay, and for revenue, it should be 0.5% of revenue. Okay, when we are talking of A is for total assets. Okay, and an item is material if it constitutes 1% of total assets, and P is for profit before tax. Okay, if the item is 5% or more of profit before tax, then that item is actually material. So you need to point out to the examiner, because by the end of the day, you need to relate these materiality computations have to be related to the financial statements. Okay, so it's actually calls for your professional judgment and professional thinking, because the relationship should actually be reasonable. Okay, for example, when we are talking of a provision that has to be made, obviously, you don't have to judge the materiality of the provision based on the revenue percentage. Okay, because usually the provision is linked either to the profit before tax or to the total but usually the profit before tax, okay, not actually revenue. All right, so at least if you talk of the profit before tax and with regards to the provision, okay, sometimes yes, the total assets, but the profit before tax is actually the best measure of a provision, right? The total assets, yes, because the provision is a liability and it is a balance sheet item, and total assets usually used to to match the materiality of balance sheet items. Statement of financial position items. Then you might as well use the total assets. Okay, and but the best measure, especially when a provision is understated, it means that we are trying to uplift our profitability. So the profit before tax is usually a good measure there. Okay, but to use the revenue as the basis, well, it might be, but it doesn't sound good. Okay, so you need to relate your computations of materiality with some reasonability. Okay, some psychological awareness of your procedures. Okay, that is it. So basically, you need to calculate the materiality and relate it to the financial statements. You need to tell the examiner that because of the fact that ABC is 5% of profit before tax or over 1% of total assets, therefore this item is material to the statement of financial position or material to the statement of profit or loss, and hence the directors need to amend the financial statements, something like that. Okay, I think we are done with the ROM, and let us remember, this video is actually a continuation of the first part. Okay, so let us just continue as usual. All right, so I expect you are watching this video after watching the part 1, okay, or the part A to this video. All right, let's talk of detection risk. Okay, how do you answer detection risk question? Usually detection risk is not going to be asked alone. Okay, usually detection risk is asked when you are required to determine the audit risks themselves. Okay, so that's when you need to incorporate the aspect of detection risk. And we say that this is the risk that the auditor's procedures are not going to detect the material misstatements within the financial statements. Okay, so there are many reasons why the auditor might fail to detect an error within the financial statement or the fraud. Okay, and this could be owing to the fact that the audit client is new. Okay, new audit client, or there's been some time pressure for management, which means the auditors ended up cutting corners, or there are some lack of resources. And then the competence issues. The auditors are not competent enough to carry out the audit, and there has been some use of third-party services, third-party services or service organizations. So if your client is using a third party, let's say for their payroll or for their IT, and you've determined that the payroll is actually a significant figure, or the IT system itself is actually part of the financial system of the client, then because they're using a third party organization, then that might create some detection risk, because the third party might not be cooperating, and that might increase the detection risk. Okay, so you need to lead yourself within a situation, or within the scenario. If the examiner clearly points out these issues, you need to actually pinpoint them. Okay, now I think we have done much in terms of the audit risk aspect. We looked at the risk of material misstatements, where we say that this is made up of the control risk as well as the inherent risks. All right, and inherent risk, we determine that it is actually spanning from the nature of the client's business, what they do, all right, or the circumstances surrounding their operation. All right, for example, if they are an online trade, if they are an online trading organization, then there are some issues related to the recognition of revenue, or if they are a business that deals with high-tech products, then there is an issue of event revaluation that is related to those to their business, because these inventories, their inventory can easily or can frequently get obsolete because of the fact that they are in a high-tech industry where things ought to be fashionable and within the the preferences of the customers, who might actually have change taste on a frequent basis. Okay, so inventory valuation might become an issue, or the entity might be a, an organization that imports or exports materials from other countries, and there could be some issues to do with the foreign exchange rates and so forth, the translations. Okay, so those aspects related to foreign transactions might also create some risk of material misstatements. So the nature of the business has got a bearing on the aspect of ROM. There's also an issue to do with the control risk, okay, where we determine that the control culture of the organization is not that robust and the control systems are not operating as they should, or for example, there has been some, a new system that has been put in place, a new financial system. They've moved from an old one into a new upgraded system. So there could be an issue of, the client personnel is not yet fully trained or at grips with the system. So those might also create some errors within the system and so forth, as they would be inputting their data. Okay, or the entity itself, the managers have got a tendency of overriding the controls, so that's a control risk, and that might create the risk of material misstatements. All right, or they do not have adequate security personnel, which means they are a retail trade, but stuff, or inventory could be easily stolen and so forth, which might as well affect the inventory valuations and so forth, or the sales figure might be not what it's supposed to be, or the cost of sales could be not what it purports to be. So those are the items which we pointed out within the audit risk aspect. Now let's then conclude our video with the aspect of business risk. Okay, now business risk. This is the risk that the business of the client won't be able to meet its intended objectives. So why do we have to bother? We are not the client, we are just auditors. Why do we have to bother about the client's business? Well, we need to be bothered. Okay, we need to worry about the client's business. Why? Apart from the fact that, from the commercial fact that if the client's business falls or closes shop, we won't get our income. Okay, we won't get income because we would be out of business. If the client fails, we won't get anything in future. We also need to be worried towards the audit risk. All right, certain business risks usually graduate into audit risks. Okay, so for example, we need to plan audit procedures to ensure that the client is a going concern. Now, if we do not open our eyes, open our professional skepticism, we won't be attending to the requirement that we need to conduct procedures to assess the going concern assumption of the client. So this means that the client's health, the client's business activities actually apply to our audit procedures. Okay, so we need to be careful. So business risk in an examination, when the examiner says identify business risk, these are all negative activities that would have a bearing on the client's business, okay, or all negative events, all negative situations that have a tendency of affecting the client's business, reputation, cash flows, and so forth. Okay? For example, the client's supply chain management has been affected very much because of a war in a certain country where the client suppliers have got a sustainable railway connection or railway network. So this means that the business is now going to join a certain or another supply chain network, this time which uses sea travel. But due to the nature of the client's business, which is a high-tech industry, okay, which is in a high-tech industry or in a fashionable goods industry, this would actually affect its operations because the items are going to take time before they are delivered, when in actual fact, by the time they will be received, they would be obsolete. Okay, so business risk is anything that is going to affect the business operations of a client. So you as an auditor, if you listen to this particular story, you need to be in a position of identifying what a business risk is and what an audit risk is. Okay, a business risk in this scenario is that the client is going to receive goods which would not be sold to the customers, and this will result in the client losing its market share or annoying its customers, who would end up going for its competitors. And by the end of the day, the sales of the client are going to shrink, and they will be in a position where their cash flows would dwindle or would fall. That's a business risk. Don't mention about inventory valuation and so forth. That's inventory valuation is now an audit risk, because here now, in the same scenario, we can as well determine that there is now a danger in the valuation of the client's inventory. Okay, because inventory should be valued at the lower of cost and NRV. In this case, the NRV of the client's inventories could be misstated. Okay, could be overstated. Actually, there's a risk that the inventory of the client could be overstated. Why? Because by the time these inventories arrive, the client might want to maintain the original cost of the inventory. Yet, in actual fact, the net realizable value of this inventory could be far much lower, okay, which might require an inventory write-down, which the client might not want, because it could be having it could be having some negative impact on their profitability. The write-down, remember, is an expense, and this might actually negate their profitability. So they wouldn't want such a situation. You can then go ahead on the audit risk section to say, given the situation that they want to get listed or they want to appeal to their shareholders, then this risk is actually very high. Also, given the risk that the managers are given performance-related rewards the motivation for not writing down the inventories, inventory values, is actually very high. Remember, when you're talking of the motivation, we're talking of the risk. Okay, so the motivation for them not to write down inventory could be high in this case, because remember, they would be paid on, on commissions, or or on performance-related rewards system, okay, or on the percentage of sales revenue or percentage margins achieved. So that would actually lead them not to report the correct thing. So basically, in the exam, when you're talking of business risk, these are activities with a negative impact on the business, or negative impact on the cash flows. We are talking of reputational issues. We are talking of legal or compliance issues, their impact. If you are given financial statements, for example, a statement of financial position or a statement of profit or loss in the exam, and some comparative for the previous year, make sure you support your allegations of business risk with trend analysis. Okay, whether the revenue is going down or up, whether the costs are rising, you need to do all those analysis to ensure that you support your arguments. Remember, this is a high-profile exam, and you are required to show the maturity in terms of trend analysis and linking evidence from the narratives, the narration part of it, and the financial statements given. Please don't just ramble. Don't just ramble about everything. You need to actually be in a position to, support your arguments clearly and in a mature manner. Okay. I think we need to try and look at a past exam question. Okay, we need to look at a past exam question to see if we can make sense out of this presentation. So I expect you to hang on to the next video, as I'll be explaining a past exam question, so that you see what I mean, so that we consolidate everything on how to answer a business risk question as well as an audit risk question. So please stay tuned to the next video. Thank you.